All right, good afternoon, everyone. Welcome to our June 2023 webinar, Investing 101, Ask the Chief Investment Officer. I'm Dave Clayman. I'm the CEO and co-founder of 12 Points. Many of you know me. I have with me Steve Bruno, our Chief Investment Officer. And so we're going to have some conversation about markets, what's going on in 2023, what happened in 2022, and where we think we're going. So we'll do a little Investing 101 to lead us off, and then we'll kind of get into a specific question and answer session. So, Steve, one of the things we hear a lot for those who are new to the scene is I hear equities, I hear stocks, I hear ownership, I hear all kinds of different terms thrown around. Just a basic, what's the difference between an equity and a stock?
Nothing.
There we go. Exactly. Thank you.
Both are basically synonymous for ownership in individual publicly traded companies.
Perfect. And why do I want to own a stock? What does it get me?
Well, if you look at hundreds of years of history, those shares tend to go up. And the other nice thing is they tend to go up more than inflation. So you tend to maintain your real purchasing power over long periods of time.
Great. And if we own, some stocks are designed to give us dividends or income, and some stocks are designed to give us more growth. So correct. We try to have a balance of both in our portfolios.
That is correct.
And you buy the right kind of stock for the right situation for you. And that's kind of how we look at when we build things. So the other thing we hear all the time is bond, fixed income. Same thing, different thing?
Same thing in the sense that they're both synonymous of a security that a public or actually a private company can put out, and the government as well, that is basically borrowing money from investors, and they can pay either a fixed coupon or fixed rate of interest or a floating rate, depending on the structure of the security.
Perfect. So bonds aren't always fixed income. They could be floating rate income, but generally people, when they say fixed income, they're referring to the bond category.
Sure.
Cool. So let's get into some of the fun stuff now. Let's talk about what's going on in the economy since there's so many different people talking about
it. Well, the economy has been growing actually for probably now the last 3 years since that little COVID recession that we had, which although huge in terms of magnitude, was actually incredibly short. It actually was only 2 months in basically the spring of 2020. If you recall, as we came out of that recession, the majority of folks were buying things. They were buying cars, they were buying bicycles, washing machines. You couldn't replace an appliance in your home for any amount of money. The amount of used cars and even new cars that were sold was incredible. And in a lot of cases, that pulled the demand forward. So rather than having 2-3 years worth of demand, it all seemed to get sold within a 9-12 month period.
We couldn't do anything, go anywhere, so we had to find something to keep ourselves busy.
Exactly. And there was a lot of money floating around. The government basically dropped money from helicopters in terms of trillions and trillions of dollars, not only in the US, but globally. And that pretty much set the stage for a big buying spree.
And it's hard to understand how much $1 trillion is. So this is my fun fact on how much $1 trillion is. $1 trillion is $1 million a day for 30 years, basically. That's an astounding amount of money. And then to think we dropped how many trillion? 3, 4, 7. There were lots of trillions of dollars. So just thinking about
globally.
Yes. So just thinking about how much money that injected into the system, and amazingly that caused inflation. That's shocking.
That did. As Milton Friedman said, inflation is always and everywhere a monetary phenomena. And what happens when you have too much money chasing too few goods, the only choice to balance that equation is for prices to rise. And that's exactly what happened. If you look at through the middle of 2022, inflation in this country probably peaked in the just shy of 9% range, my recollection, depending on which measure you use. We're down to the 4 to 5% range, at least on headline inflation. But if you look at sort of underneath the covers, the inflation that we are seeing in services, which tend to move much more slowly in terms of adjusting prices, that's running 5-6%. And that is what's given the Fed a lot of heartburn, particularly recently.
And there's probably something to that. You talked about we couldn't go anywhere or do anything before, so it was goods inflation we're seeing. Now maybe people are starting to get those services and experiencing that, and maybe that's why the inflation is still there in those categories?
Absolutely. So we switched from consuming goods to consuming services or experiences, as the media likes to call it. So that's manifesting itself today as sky high plane tickets, impossibility to get a reservation, whether it be at a hotel or a restaurant. So all that money now is being spent, excess money is being spent on, as I said, experiences, services, and the like. And that is, those prices change much more slowly, and is actually driving wage inflation. So if you look at particularly in the service sector, hospitality, for example, wages have been growing probably in the mid-single digits, 6-7%. Overall wage inflation is running in the 4+% range. So when you mix all that together, it's very difficult to get inflation back down to the Fed's target, which in theory is 2%.
So that's going to lead me to a question I did not prep with you for, but it's a fun one. So the Fed has a stated 2% target for inflation. And we are currently sitting anywhere from 3 on the PPI to 4 on the CPI, but 5-ish range on the core. So you have those sticky inflation type things. Why is the Fed pausing if we're so far from the goal?
Yep, I mean, I think that was obviously an important question this week, because we just had a Fed pause this week. And the interesting thing, and this is a little inside baseball, because of the debt ceiling and the fact that the coffers of the United States government was run down to a ridiculously low amount of money. I think it actually fell below $50 billion. Now, I would personally like $50 billion. I wouldn't think that's
not a lot to run the country, though.
that barely runs the country for a couple of days. So we got pretty close. They actually paused in order to help the Treasury refill the government's coffers by probably nearly $1 trillion worth of T-bills over the past couple of weeks.
It's a little inside dealing there.
That's a little inside baseball, but
little inside dealing. You need to borrow money, and I get to control the rate at which it's borrowed at. Let's not raise the rate. Interesting. That's the first logical reason I've heard, because I can tell you when they come out and say, well, we're going to have to. We want to be in front of inflation. We want to be raising ahead of inflation. And then all of a sudden they say, we're going to have to raise again, but we're stopping now. So that's great to know that it's the Treasury bill story.
Well, yeah, and the funny thing is, the spotlight obviously gets put on this because almost every other central bank this week has raised interest rates, some of them to a surprising degree. You look at the Bank of England today, they raised by 50 basis points because the inflation problem in the UK is actually worse than the one that we have here. And so they surprised to the upside on their raise.
So a 0.5% raise. So I guess that's going to lead me to, I know we're having a little Yul Brynner flashback here with your terming of the Magnificent Seven stocks, but we're seeing policy from central banks being more and more restrictive. They're still trying to drain that liquidity that came from the monetary policy side of the house. So, excuse me, from the fiscal policy side of the house, excuse me. So if monetary policy is becoming more and more restrictive, why are we having this exuberance, particularly the Magnificent Seven, but in general for everything's going to be fine, the market's going to roll through this, we never saw a recession, what's going on here?
Right. So, I mean, that leads just to put a bow on the prior conversation that we had in terms of the economy. So, if anything, we're having probably at best a inventory correction on the good side of the economy, at worst of sort of a rolling recession through the good side of the economy, and that is largely driven by excess ordering and things like that from back in the early COVID recovery. So the economy itself is continuing to roll along as we mentioned earlier, and yet the stock market is in this massive divergence. You had pretty much across the board in 2022 weakness, all kinds of stocks. The S&P was probably down about 18% last year. The interesting thing, though, is if you look at this year, it's at least one part of the market is a complete mirror image, and that is this group of stocks that we call internally the Magnificent Seven. It's the names like Apple, Amazon, Google, Meta, Tesla, Nvidia. These stocks in total have some very interesting characteristics. Year to date, they're actually up. Those 7 stocks are up 60%. And they represent more than 100% of the total return on the S&P this year.
That's totally normal for a half a year.
Well, it's actually more interesting because if you look at, so those stocks are up 60%, the other 493 stocks in the S&P are up about 5%. If you look at last year, 2022, those same group of 7 stocks were down 40%, whereas the other 493 were down about 9%, which is what, again, on a weighted basis, drove the S&P down about 18%. Now, if we rewind back to the end of 2021, and we put $100 in the group of 7, and we put $100 in the other 493, as of yesterday, we would, in both cases, have $95 left.
So down 5% on both cases.
In both cases. So you had a massive catch up by the Magnificent Seven and kind of a plodding along of everyone else. So although those Magnificent Seven are catching the headlines, and there's some interesting undercurrents in terms of artificial intelligence and things like that are driving that exuberance. But from a total return perspective over the last year and a half, the tortoise and the hare, we're back to even with each group within the S&P.
So 2 questions related to that. So one, or I'm going to make a statement. So NVIDIA has been one of the top names in the world this year. Mm-hmm. And when you look up, they're trading at approximately 40 times sales when, Mr. Buffett, who's a pretty decent investor there, Warren himself, says you should pay anywhere from 1 to 2 times sales. Right. And they're trading at 200 times earnings. How does one ever make money on a company that is, you're buying 200 years worth of work? You won't live to see that value.
No. And the short answer is history is very much against you. So for every one company that makes it, I mean, the market over the last 100 years is littered with companies that didn't come close to reaching the hype of their valuation. You look at the internet bubble back in 99, we had hundreds of companies that matched that exact.
Pets.com, I still have my sock puppet. I still have the sock puppet. He was great.
He was great. And back in early 2000, when I was actually running a technology-only fund, and I had a sell-side analyst sit in my office and try to pitch a stock to me, he said the stock was cheap on a new valuation metric. I said, oh, what is that? and it was price to concept.
I didn't hear that one. I know eyeballs. I never heard price.
No,
to concept.
price to concept. And to a certain extent, what you are seeing right now with that Magnificent Seven is a kind of a microcosm of what we saw at the beginning of 2000, where it's price to concept. In this case, it's price divided by the growth of AI, because that's really the one common thread amongst these stocks that are, really kind of driving the performance.
And AI is artificial intelligence for those who. So the other thing, so we all took finance courses, and a finance course says that the risk-free rate has an effect on your discounted cash flows and how much your company should be worth in the long run. That's standard financial analysis. The risk-free rate being the treasury bill, at least when we're not going through a debt ceiling problem, but the risk-free rate in theory is a treasury bill, was at zero just a couple years ago.
18 months ago.
18 months ago. And now it's over 5%.
Yeah, 5.3 today.
So how is our company's multiples expanding when their true valuation would seem by anyone's financial theory to be needed to be receding based on every financial model I've ever seen?
Sure. And I think for the other 493, the other 493 stocks, mid-cap stocks, small-cap stocks, I think the historical equation absolutely applies. And I think that's why the stocks have been certainly struggled last year and are up modestly this year.
I'd still take 5% in 6 months, by the way. But
I'll take 5% in 6 months as well, particularly as there's this push and pull between the Fed and earnings coming out of the economy. That's why I say that these seven stocks, the Magnificent Seven, their valuation is completely divorced from typical financial analysis. And to a large extent, this is a function of the ownership differential between the stocks in the Magnificent Seven, the Nvidias, the Apples of the world, and sort of all these other stocks, the other 493. I keep picking on the other 493, but it applies to small cap stocks and mid cap stocks as well. Those stocks, the Apples of the world, have about a 60% institutional ownership. So these would be things like pensions, endowments, foundations, and actively managed mutual funds. They probably have about 10% of that. 10% is probably in passive mutual funds.
So if you own an S&P 500 index fund or anything like that.
Right, you have no choice but to buy a stock that's in the S&P 500, and you buy it at whatever weight it is in the S&P 500. So it's a reinforcing type situation there. So if you subtract out that, only about 50% of the ownership is institutional. So by definition, about 50% is individual or retail investors. You contrast that to a typical stock in that 493, like I'm going to pick on Ingersoll Rand. Great company's been around for 100, 120 years. Strong position in compressors and just big iron that goes and drives machinery in the economy. And that probably has institutional ownership of 98%. And even if you back out the 10, 12% that's in index funds, it's still high 80s in terms of actively managed endowments, foundations, active mutual funds, and the like that are doing traditional financial analysis in terms of figuring out what is the value of those companies. So I would argue that those 493 reflect the traditional valuation methodology that you alluded to at the beginning of the conversation, or beginning of this question, I should say. Whereas the other Magnificent Seven right now are, their valuations are based on price to concept.
Hopium?
Hopium.
One of my favorite tools, hopium.
Yeah,
Need to have
yeah.
some hopium in your world.
As we like to say in the wealth management business, hope is not a strategy.
Wishing, hoping, and praying is not a strategy. That's correct. So, okay, so probably more on the emotional side in the
Sure.
Magnificent Seven and more on the logical side in the rest of the world.
And that's exactly what we saw in the internet bubble. If anything, the valuation of the mega cap growth today is at the highest it's been in the last 100 years. So it actually does exceed that during the internet bubble.
Now I want to move. I do want to talk about bonds and commodities,
Sure.
but I just want to let everyone know in here when we talk about the bubble, some of them might get scared. So your outlook overall for the world, though, is not bearish. So do you want to talk a little bit about that?
Yeah, and I'm fairly sanguine about the markets in general, more so because there's still a lot of money floating around. The economy is still chugging along. If you look at the way we got through kind of rolling recessions back in the good old days of the 90s and early 2000s, before we had the great financial crisis of the mid 2000s, what you see in terms of the overall economic conditions, interest rates, inflation, though again still a little bit high, is actually normal. This is the way I grew up. This is the kind of world that I grew up in as an investor, and I don't find that part of it strange, or that the wheels were going to fall off the world. So I guess my net on the equity market is it's more likely that there's going to be catch up from the 493, the mid caps and the small caps, whereas money can it wouldn't take a lot of money coming out of that Magnificent Seven and them just treading water to actually put a pretty decent lift in all the rest of the stocks.
So fair to say bearish-ish on the Magnificent Seven, but moderately bullish on the rest of the world.
And frankly, that's exactly what happened as we popped the internet bubble. We had a slowdown in the economy. Those stocks really tanked in that case.
Yes.
But all the money flowed back into the Ingersoll Rands of the world, and the actual overall market didn't do poorly. Now the only difference we have there is the weight of the Magnificent Seven being at 30% of the S&P. The internet bubble, it didn't quite get that high.
Yeah, so in 99, 2000, the internet got halved,
Right.
or more than that, almost 70% if I remember correctly. The S&P actually held up,
Yep.
but those big tech stocks weren't as much of the S&P. So
Right.
while we could see that shift, it would more be, you'd see value indices hold up as opposed to the broad S&P, just because the Magnificent Seven have become such a great cap weight, such a large percentage of the S&P.
Yeah, I mean, those 7 stocks represent 30% of the weight, but only 10% of the revenues and about 15% of the cash flow. It's amazing.
Crazy, absolutely crazy. And now equal to what, Germany, France, and 2 other large countries?
Yeah, so if I remember correctly, it's the UK, Germany, France, and Japan. Those 4 countries together equal the weight of those 7 stocks in the S&P.
Crazy. 7 stocks equal to the size of 4 countries. So just didn't want to scare people when we mentioned bubbles. So let's talk a little bit about bonds, fixed income. What's going on in there this year?
Sure. And last year was a very interesting year for bonds, in that they did not provide the ballast that they typically do in a down equity market. They were down mid-teens, and frankly, that is 100% related to where they started. If you look at the end of 2021, we had 16, 17, 18 trillion dollars worth of negative yielding debt in the world.
So people were actually paying others to borrow money from them. Crazy town.
Don't get me started on that one.
Yes.
But as markets normalized, as the Fed and central banks around the world started raising rates, what you actually had is a reset of the valuation of those bonds that were yielding zero that actually now have to yield something. So, I mean, if you look at it, the bond indices are yielding, depending on where you are domestically, just shy of 4%. And Europe probably in the 4.5 range. In emerging markets, you're actually getting paid over 7% on those bonds, and all those numbers would have been zero at the end of 2021. So you had this stair step down in this case, adjustment in terms of the prices of those bonds, which now got yields back to kind of a normal place. And so you had bond indices year to date up, again, 2, 3, 4%, very much in line with where most of the stock market has been acting this year.
Okay. And then on the commodity side of the house, you want to talk about energy versus gold?
Sure. And you really should be doing both of these, but what I will say is, you look at last year, the energy was the standout in terms of the stock market. Probably the only group in the stock market that was up last year, to the tune of about 64%. So looking very much like the Magnificent Seven last year, is probably makes it also the weakest group this year, down about 8% in terms of the stocks. And I think the commodity itself is down more than 8% on a year-to-date basis.
It's not doing well today, so
It's
it's down
definitely
probably
not doing
about 15% now year-to-date.
Right. The stocks are, I mean, what you've seen over the last 5 years is a big change in the attitudes of the managements of these companies. We own a number of them. They have capital discipline. They have strong dividend yield and growth, which you did not see in, let's say, the 2010 to 2015, 16 period. They sort of got the message, and that certainly helped them last year. And frankly, I think it's one of the reasons why the commodity being down, 15%, the stocks are only down about 8% this year.
They just figured out they're not being rewarded by government policy, by anything else for further investment in that area. So they're returning that capital to shareholders. Whether that's a great long-term plan can be debated, but in the short term, that's good for the shareholders, and that's what was reflected last year. And I think, again, in the relative performance this year.
Agreed.
And as you know, I am a fan of gold.
Resident gold bug?
Not quite to the level of a gold bug, but I certainly think that gold is an attractive holding in the current confusing bank policy world. So thoughts on gold versus anything else?
I agree. I mean, I think that the one risk that we have in this country as the amount of debt that the government has to issue continues to grow. And if you look at the CBOE numbers, they're disturbing to say the least. We saw what the government is willing to do in COVID, which was effectively debase the currency by dropping money from helicopters. And they certainly can continue to do it again, just not as obviously in terms of the Federal Reserve's willingness to basically monetize debt. And I think it's critical that being aware of the potential for inflation, remaining at a higher level for a lot longer than anyone anticipates is, one of the main reasons why we have gold, but it's also one of the reasons why we have commodities and real assets in our clients' portfolio.
So monetize, or wink, wink, nudge, nudge, not raise rates when we need to borrow some money. So, and I think that's, and I realize we're a few minutes over, I think that's the thought that we would probably leave you with is, don't think inflation's going away. One of the things when you are the most indebted country in the world, the best way to pay back that debt is in discounted dollars. So for inflation to be higher, your citizens be darned and the effect on them, but it is easier to pay back a large number in a deflated dollar. So that's where inflation can be helpful to the government. They're letting it happen, and so I would not expect inflation to fall off the table anytime soon.
Agreed.
So with that, again, the outlook is generally positive for the majority of the market. Significant concerns for large cap growth and what the next 5-10 years might look like for that area. But we continue to look to value and opportunities. We're pleased to finally be getting some yield from our fixed income bond portfolio. And real assets, things you can, if you dropped them on your foot, they'd hurt, is a good place to be hiding for now. So anything else you'd leave for parting thoughts?
Thank you for your time.
Awesome. Thank you everyone for joining us. Hope this was informational, and we look forward to seeing you again next month.